You want to watch a stock like Apple or a stock like Microsoft, which is bulled very heavily by Jefferies, see if they can hold their own. Salesforce, which I thought was wrongly accused yesterday. A lot of the analysts are following down stocks, cutting price target. I like that, too. So we have the makings of what could be a bottom. 2 weeks ago, I talked about a checklist I used to identify when the market was bottoming. See, at the time, the market had been going down. I didn't see a bottom because I was being dispassionate about things I look for. I said there could be more pain to come. We didn't have enough checks. The market was still too high to me. It was too perilous. Didn't want to put any money to work from a charitable trust. Still taking money out. Now, though, especially after the total despair of the last hour today, I'm actually feeling a little more confident. This is what a bottom could look like. But the bottom line, we do know you're a fool if you think that things are only just now getting bad for the stock market and can only get much worse. It ain't a dip, people. It's been going down since November, thanks to this endless sell-off. But you know what? Maybe we're a lot closer to a bottom. Bottom line, fortunately, because sentiment is already so negative, that bottom could come sooner than you think. These are great American companies, and you could own a piece of them. When you buy here, I know you're fighting both the tape and the Fed, which is going to tighten, hopefully aggressively on Wednesday to get these defeatists out of my face. You can't be confident that the pain is over. So why we buy it all? Because I think things are better than others do. I think the asset class is nowhere near as tainted as some seem to believe. I'm willing to take a beating in order to purchase stocks that are just too cheap at the moment, even with that darn 10-year 3. I bet they'll turn out to be great buys someday, sometime. I just don't know when. When the market comes down so far, so fast, the pain eventually ends. And when it does, then you get that snapback rally that you wish you were a part of. The snapback rally can be just as rapid as the decline, like we saw near the close today. Not many people saw the bounce coming. Right now, this market makes you feel like the world is ending, though. The thing is, it never feels good at the bottom. It always feels awful. The pain doesn't stop until the bulls abandon all hope, at which point everybody who was going to sell has finished selling. By the way, that's the way it felt like at 3:30 today. And that's when stocks stopped going down. I said to David that July 13th would be the bottom. I said that in February.
Is that today or tomorrow?
Tomorrow. And killed Exxon.
What happened to that market bottom on July 13th?
That was my daughter's birthday. That's my birthday.
Oh, now we're just then.
Right.
Okay.
All right. Today is Monday, July 18th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. But before we start, some sad personal news. Unfortunately, my oldest dog, my old lady, passed away over the weekend, almost at the age of 16. She was a great friend for a long time. In her later years, she became deaf and blind, and she was wearing a diaper, and she required a one-on-one attention and care, but nonetheless, she was still kicking, and she was a source of inspiration and motivation to me. Sometimes I'll get back home late, I don't have the energy, I'm worn out, and I say, let's pass, I'm not going to make a video tonight, but with her company sitting next to me late at night, I get the motivation that I need to make a video. So if you enjoy watching videos from this channel, she had a role in that. But now she's gone, so rest in peace, and I just wanted to pay tribute to her. But anyways, let's get back to business here. I hope you liked the montage in the beginning of the video. You know, Jim Cramer is known as the broken clock of Wall Street, and therefore we have the inverse Cramer ETF. We have all these jokes, of course, but Jim Cramer has been calling the bottom over and over and over and over again. Could he be right, though, this time around? Maybe. You know why? Because all of this that is going on right now in the economy and the stock market is very reminiscent of the year 2008. And back then, Jim Cramer made a similar prediction, and he was right until he wasn't. So the question is this call this time around of market bottom just a replica of his call back from 2008, a deja vu? Which set of facts support a market bottom right now? Which set of facts oppose a market bottom right now? Let's talk. And here it is, in focus tonight. 2008 Deja Vu, featuring Jim Cramer, aka Jimbo. Now, Jim Cramer today rang the bell on Wall Street, and of course, Wall Street bets and the memers had a field day with that. And while the technicals were setting up for a rally, and indeed we got a rally in the morning, you had to know the fact that Jim Cramer is ringing the bell is an ominous sign. He's going to jinx whatever rally we're going to have. And what do you know? By the end of the day, all indices closed in the red, reversing all of the gains. Once again, thank you to Jim Cramer. Among his greatest recent calls, Jimbo said back in January 3rd of this year, Netflix, buy. And if you did, you probably lost your house, your car, your wife, your kids, the dogs, everything, and you're now living in the street. Another one, of course, once again, Jim Cramer jinxing everything. On June 14th, Jim Cramer said, oil is not going down. Guess what? That was the top right there and then for oil, and oil went down by almost 26% since then. And these great calls by Jimbo go back for many, many years. The buy oil stocks at the top call was just the most recent one. But the guy has lost it long time ago. Now, unfortunately, I don't have the time to watch his program, but last time around I tuned in, this is what Jim was talking about. Take a listen.
The president wants to give us a gas tax holiday, 18 cents a gallon. That's nothing. But it's not nothing, right? I mean?
A little bit, but not enough. Biden studiously avoids doing the one thing, though, that could really
bring down the price of crude. He needs to arm the Ukrainians to the teeth so they can quickly beat Russia and put the war to bed.
The White House has been reluctant to go all in on this conflict because they're worried about triggering World War III.
I don't think they understand that Russia already sees this as a proxy war with the West, and it's not going well given that Ukraine lacks the armaments it needs to win. So oil remains in play as the Europeans are grabbing every bit of spare capacity to make up for the lack of Russian imports. And the President of the United States only sends Ukraine the bare minimum. In terms of artillery, we're sending Ukraine the equivalent of 1/7 of what the North Vietnamese used against our army in just 2 weeks of the Vietnam War. I think we should be supporting Zelensky like the Soviets supported Ho Chi Minh. Even when you put aside moral considerations purely in terms of raw political calculus, Biden needs to get gas prices down if he wants to get reelected. And the most straightforward way to do that is to make sure Ukraine wins this war decisively. At the same time, we need to see an end to rampant food inflation. Once again, that all comes down to Ukraine, formerly the breadbasket of Europe. Naturally, it's tough to farm in a war zone. Could we make Ukraine safe for agriculture? Sure. But we might have to set up a no-fly zone in the western part of the country, which Biden doesn't want to do. He doesn't want to create a no-fly zone because that's American fighter planes firing at Russian ones. And it's a hop, skip, and a jump from there to nuclear war. I understand that. By the way, I think there's a very good argument for that. But a no-fly zone is, while extremely risky, it is the best way to get food inflation under control.
I tuned in because I was wondering whether I should buy the dip in AMD or NVIDIA. But all of a sudden, the guy's talking about World War III, no-fly zones, and perhaps the remedy for world hunger and inflation is a nuclear war. What's going on here? But anyways, Jim Cramer has been calling the bottom over and over and over and over again. And at some point, you gotta be right. At some point, the broken clock gotta hit. And the question is it this time around? Is the broken clock finally hitting? Let's go back in time to 2008. And some of us might actually remember all of this. I do. I was trading back then. But here's the article from Insider, dated September 6, 2008. The headline reads, "When will Jim Cramer call the bottom again? Question mark. At the end of July, notice the similarities and the parallels. At the end of July, Jim Cramer called the bottom. Specifically, he said the bear market was over and it was time to back up the truck. For a while, it looked like Jim Cramer might be right. Now, with the market below where it was when he made the call, it looks like he'll get another opportunity to call the bottom. Will he? Question mark. When? Question mark. Place your bets." Now, a reminder for you, here's the NASDAQ chart back in 2008. And as you can see, we got the famous consolidation pattern with lower highs and higher lows. Once that was broken, the crash happened and the rest is history. But there is a take here. Back in July 2008, that was the top in oil. Oil topped and started to crash down, just like we got this time around in July. We got the top in oil. We're talking about oil stocks, of course. And since then, oil price has been crashing. We'll see if they're going to rebound and recapture the highs or not. But for now, we know that oil prices crashed big time. The energy sector is down big time. A similar phenomenon happened back in 2008. And since that top in oil in July 2008, guess what happened? The Nasdaq rebounded higher. We got a rebound rally worth almost 12%. And during that rally, everybody was saying, oh, the inflation fears are gone. Oil prices are down. You got to go back into the market. This is the bottom. Load up the truck and higher we go. And we all know how that ended. Fast forward, after Jim Cramer realized that he's wrong, he came out and made a correct call for once. The headline from Insider dated October 6, 2008, Cramer, panic now and sell everything. Jim Cramer has apparently revised his late July market bottom call. On the Today Show this morning, the guru, what are you talking about? Anyways, told investors to sell everything. One of our hedge fund friends describes this as the Manichaean scream moment. I thought about this all weekend, Cramer told Curry. I don't want to say these things on TV. Whatever money you may need for the next 5 years, please take it out of the stock market right now, this week. I don't believe that you should risk those assets in the stock market right now. Anyways, back to normal voice, because I don't want to damage my vocal cords. Cramer added, I don't care where stocks have been. I care where they're going. I don't want people to get hurt in the market. Wow, Cramer told Curry. I'm worried about unemployment. I'm worried about purchases that you may need, and I can't have you at risk in the stock market. Wow. Back when Cramer had some integrity. But of course, all of that integrity went out of the window when he made his most famous call of buying Bear Stearns right before it crashed. But anyways, Jim Cramer was right for a moment in 2008 when he called the bottom in July, right after oil prices topped. He did the same this time around. Could he be right? Could this be indeed a tradable bottom at least? What are the pieces of evidence that we have that support that theory? Well, number one, we have the Wall Streeters, the analysts, coming back to reality. The market sentiment witnessed a major adjustment. All the hyper bullishness to the moon, bro. All of that insanity is defeated and broken. Just last year, when this channel was warning market investors that inflation will break the market, we will see a crash, we got taunted in the comments by the perma bulls, the pumpers, the gamblers, the Robin Hoodiots, the apes, saying, oh, you don't understand, bro. You're just a jealous loser. Stocks will go to the moon. What do you know about it, boomer? Well, all of that sentiment is now gone. All of these people are silenced right now. Not only them in the retail crowd, but even the perma pumpers on Wall Street are adjusting their expectations down. Look, for example, the clowns in Oppenheimer. They recently revised their S&P 500 year-end target from around 5,400 all the way down to 4,700. Still insane, still doesn't make sense, but at least the hyper bullishness is being washed away out of the stock market, and this is good. Another point that supports a bottom, tradable bottom at least, for now. We talked in details in last night's video whether the Fed will do a 100 basis points plus rate hike in July or not, or is it going to be 75 basis points and then we go down to 50 if not 25, and after that easing. We'll take that one step at a time, but in last night's video I came up with a conclusion, at least for now. I believe that the Fed will do the 75. No 100 basis points, at least for now, unless the stock market rallies hard into the meeting, which we're not seeing at least for now. It's not only me who says that. The folks at Barron's, they say don't buy the hype. Why the Fed will not do a full point rate hike. Goldman Sachs came out today and said the Fed will not raise interest rates by 100 basis points next week. And if that is the case, that supports a tradable bottom for now. Another piece of the puzzle supporting a tradable bottom for now is this one. The headline reads, a stock market bottom could be near as short sellers become hesitant to press bets after making nearly $300 billion in profits this year. So if you wondered where your crypto gains, your meme stock gains, your stupidity gains went, the answer is in the pockets of bears. Thank you so much. And the bears are sitting on $20 billion in profits from shorting FANG alone. What does that mean? At some point, the shorts have to cover. At some point, the shorts have to book profits. And when they decide to do that, that would be the tradable bottom right there and then. Do we have a catalyst right now that could launch a short covering squeeze? The answer is yes. We have earnings. Now, so far, we're starting on the wrong foot You might have heard IBM's earnings after the bell. Not so hot so, and the stock is down big after hours. But what if we have good news from Netflix, for example, tomorrow? That could initiate a short squeeze, and if that happens, it will mark the tradable bottom, the summer rally, at least for now. And then the pain resumes in the fourth quarter. This is at least what we got back in 2008, and I believe that we are pretty much in a parallel to 2008, not just from a market perspective, but also from an economic perspective. Now, what pieces of evidence, what set of facts opposes the tradable market bottom theory, the summer rally theory? Well, how about the breaking news that we got today? Take a look.
Let's get back now to the story that's driving stocks to a session low at the moment. Bloomberg reporting that Apple is planning to slow hiring and spending for some teams in 2023. Joining us now is Bloomberg's Mark Gurman, who actually just broke this story. Mark, you are moving the entire market here. Walk us through what's actually happening within Apple right now.
So as Apple prepares for 2023, the company is going to reduce hiring and spending growth for some teams. This is in response to the obvious looming recession that people are worried about, an economic downturn. So the company is taking a more cautious tone in preparation for that. Now, of course, this is not company-wide. Apple has more cash than just about anyone on hand, so they will be able to sustain any issues coming from this recession in all likelihood, or this looming recession, I should say, in all likelihood. And so they are doing what they need to do to prepare for that by not hiring as aggressively as they might do. Still, they have a pretty packed product roadmap for next year that includes its first mixed reality headset. That would be its first major new product since the Apple Watch, which was announced in 2014. So this is a big deal. All hands are still on deck for that, but they're taking a more cautious tone. We've seen Amazon and Tesla and Meta and the likes of all of Apple's peers have these more cautious approaches for next year and the end of this year. But of course, Apple's is more limited to some teams rather than company-wide. And it does not appear that Apple has any layoffs planned in the near term either.
Well, Mark, that you went right where I wanted you to. This is just a hiring slowdown. We're not at layoffs yet. 30 seconds here. Do you foresee perhaps Apple hitting those layoffs?
May I answer this one? Because all of these so-called reporters are in the pockets of the iMob, aka Apple. They're not going to badmouth the company. They're not going to give you bad news without saying, oh, but here it is. This is the beginning stage of the upcoming tsunami of layoffs. They freeze hiring. That's step number one. Step number two, they get rid of some employees. Step number three, when stocks crash big, the economy starts to sour, the consumer demand goes down, here comes the waves of layoffs. And Apple is not immune. Matter of fact, Bernstein says Apple's near-term future looks murky as consumer spending slows. What are they talking about? They're talking about the fact that the consumer is running out of ammo. Inflation is squeezing the consumer budget. They're spending more at the pump, they're spending more on rent, they're spending more at the grocery store, they're spending more for utility bills, heat wave, anybody, or whatever they have left. And when they swipe those credit cards up and down, up and down, up and down, they're not spending on buying goods anymore. They're already loaded in goods. They already bought notebooks, laptops, iMacs, Big Macs, iPhones, doesn't matter. They bought everything. Whatever they have, and whenever they spend using credit cards, they're using that in services, specifically travel and leisure. And that's going to fade away after the summer too. We're already seeing signs of that, and we will see more pain in travel and leisure. All of these cruise ship companies, airlines will actually start firing employees. You watch. Why do I say that? Because we already have recessionary factors in the economy. There is already a recession hitting the poor and the lower middle class right now. You don't feel it if you're in the middle class or the higher middle class, the rich. You're not seeing a recession in the economy yet. You're still in inflation/stagflation. But as the economic cycle evolves, that recession will work its way higher to the middle class, to the higher middle class, to the rich, to the oligarchs, to everybody, and the economy will fall apart. And therefore, you have Bank of America, for example, slashing the stock market forecast and calling for a mild recession this year. We're already kind of seeing that in the poor and middle class, but that mild recession will become intense, perhaps by the fourth quarter of this year, or by early next year. Now, can the Fed engineer a soft landing? Well, we're running out of time. The odds for a soft landing are diminishing by the day. The longer the Fed waits, the harsher the recession will be. Waits for what? Waits for normalizing the monetary policy and killing this insane inflation by raising interest rates higher. Another fact that supports that this is not the bottom. We're not going to see a tradable bottom. Remember the catalyst that we talked about just a few minutes ago? Earnings? Well, valuation metrics are not down enough, meaning these earnings estimates right now are out of whack, and in reality, you will find out that earnings are disappointing, and valuations for stocks will have to go down. Look, for example, at the S&P 500 price-to-sales ratio. Even after the pullback that we got this year in stocks, both the S&P 500 and the Nasdaq are in bear market territory. But even with that, the price-to-sales ratio right now remains at the same levels of the peak of the dot-com bubble and the eve of the 1929 crash. In other words, we have to go down further in equities valuations, and hence, no tradable bottom for now. With that being said, let me know in the comments, which one do you support? Do you think that we're going to have a tradable bottom for the summer at least? Or do you think we're not going to have a tradable bottom anytime soon, and we need to go down even more? Here's my 2 cents. A tradable bottom will not happen absent a few things happening. Number one, a cooling down in the 10-year yield. Number two, the inversion of the yield curve has to stop, has to pause at least. Number three, the dollar has to go down. You cannot have a tradable bottom in the stock market with the dollar being this high. Number four, we need to see more participation, specifically in the options market. We need to see the put to call ratios improving toward the call sides. We need to see more buying of calls, more conviction that the stock market will go higher. Number five, we should get signs that at least inflation is peaking and the Fed will not have to raise interest rates higher as we thought it would, meaning the 100 basis points or more. Some would argue that we already have number 5 in the bag. We got some recent inflation data combined with the recent action in the commodities market suggesting that inflation might be peaking. We also have more signs that the Fed will not do the 100 basis points hikes. So again, what do we need here? We need, number 1, a cooling down in the 10-year yield. Number 2, a slight, at least, re-steepening of the yield curve. Number 3, the dollar has to go down. Number 4, more participation in buying call options. For now, we're not seeing any of those in a sustainable way. So keep your eyes on these 5 conditions. If they happen, we have a tradable bottom. If not, then we don't have a tradable bottom. And with that, folks, let's move on and find out whether we have any of these conditions happening right now in the stock market. And let's start by covering how the indices performed today. And here we go. The Dow Industrial Average down for the day by 215.65 points, or a decline of 0.69%. The Nasdaq down in the red, losing 92.37 points, or a decline of 0.81%. The S&P 500 also down by 32.31 points, or a decline of 0.84%. The sector's performances led by number 1 capturing the gold medal, energy, number 2 for the silver, materials, number 3 for the bronze, cyclicals. On the other hand, the laggards of the day led by healthcare, utilities, and technology. Now, we started the day with a wholesome rebound. Everything was in the green, almost. But which sectors stood still after the dust was settled? The answer is the inflationary sectors. We're talking about energy and materials. Does this mean the revival of the inflationary trade? Buy metals, buy fertilizer stocks, buy oil and gas? We got to see more evidence. Certainly the action in the futures supports that, but we have to see more evidence. You can trade all of these via call options, but the question is, do you invest? Do you buy shares? The answer is, we need to see more evidence. What about the advance to decline ratios? NYSE 53% advancing versus 42% declining. The Nasdaq 45% advancing versus 50% declining. What about commodities? Here it is, the rebound in crude energy across the board. The WTI closing with gains of almost 2%, while Brent was the winner, closing the day with gains of over 5%. A big rebound. It was anticipated. We knew that Biden will come out empty-handed from the Saudi trip. A lot of folks dumped energy in anticipation of that meeting. Nothing came out of it. Here comes the short covering / dip buying. Likewise, gasoline futures, the RBOB moving higher and gaining about 2% for the day, while heating oil futures down by almost 1% for the day. Who needs heating oil when you have a heat wave? And then you got natural gas continues to gain, speaking of the heat wave, closing the day with gains of almost 6.5%. You want to cool your home? You got to use natural gas, at least in the most important parts of the country, and therefore natural gas is catching a bit. Here's some energy news for you. The heat wave is not just in the South and Texas. it is across the Atlantic and Europe, perhaps a more intense one. We have the hottest night on record in the city of London, England. And look at that, the guard with the funny hat, right? How are they going to survive in a 104 degrees weather? And this is pushing energy prices higher across the board, but specifically natural gas. Back to the futures, what about softs? Massive gains today for coffee futures, gaining about 8% today. We also have modest gains for sugar, OJ, and cocoa futures, while cotton futures were pretty much in the flat line. On the other hand, we have a modest decline in lumber futures, losing ground of around 1% for the day. What about metals? Modest gains for gold and silver. As if gold and silver are waiting for the dollar, they're not trusting the move, the downside move that we got in the dollar today. They're waiting for confirmation. On the other hand, we have sizable gains for platinum, copper, and palladium futures. I'm watching copper because when copper rebounds and starts to move higher, that kind of supports the tradable bottom theory. That kind of supports more risk on in the economy, more expansion, more growth, more good news. Now you might say, but if copper moves higher, isn't that inflationary? Of course it is. But right now, the market is not really concerned about inflation anymore. Instead, the market is concerned about two things. Number one, how sticky inflation will be. Number two, recession fears. And that's what scares the market the most. And if copper continues to crash, losing ground of $3, then that is your recession confirmation. And the market doesn't like that. What about meats? Green across the board, big gains led by live cattle futures gaining about 4% for the day, followed by lean hogs futures with gains of about 2%. Likewise, feeder cattle futures also gained about 2% for the day. What about grains? This is not how they closed. Here it is. All in the green. Massive gains. Oats gained over 3%. So did rough rice. We have gains of over 4% for soybean oil futures. Likewise, wheat gained almost 4% for the day. Soybean futures in the green. Soybean meal futures. Corn all in the green. No problems here. Rebound day for grains. Now, what is the catalyst for the gains in grains? Perhaps it's the same reason for the gains in energy. The heat wave. The headline reads, corn yields are waning, milk output is shrinking, and chickens are sipping electrolytes as unprecedented heat bakes some of Europe's key farming regions. On top of that, the wheat output all in all remains short. Russia's producing more and benefiting from higher wheat prices. The EU is doing the same, but with the World Economic Forum restricting farmers, who knows? Then we have the US, and the wheat output is down. We talked about it in numerous videos before. Farmers are choosing crops that are less dependent on fertilizers, such as soybeans instead of corn and wheat. And the reason is we have a shortage of fertilizers, and fertilizer prices are sky high due to the war, the sanctions, whatever float your boat. Canada, the output is down. Australia, the output is slightly higher. And then Ukraine, for understandable reasons, the wheat output is down big. All in all, with short wheat. The supply is not here, and that supports higher wheat prices for a longer time. We're not saying that wheat is going to reach all-time highs again. What I'm saying is, once again, how sticky the inflation in wheat will be. And the answer is, it will be sticky given these facts. On top of that, perhaps this is a little bit of relief. Maybe this piece of news will ease the inflation in wheat prices. The headline reads, U.S. panel rejects duties on fertilizers from Russia, Trinidad, and Tobago. So all of this tough talk about sanctioning Russia and all of that, now all of a sudden, we're not going to charge duties on Russian fertilizers? I guess we need them. Our farmers need lower fertilizer prices, and therefore that dictates the conversation. The question is, did we plan for all of that? Apparently no. Apparently the Russians were more prepared for all of this, and they're benefiting from the inflation in wheat prices, fertilizer prices, energy prices. You know the story. Moving on to options, the big casino, what's going on here? The hottest table by far is Apple at around 1.4 million contracts traded today. But look at this, only 46% of those were calls. So the volume all in all is moving down again, and they're buying more puts than calls. Not a good sign if you're looking for a sustainable rebound. But at number 2, Amazon, at around 880,000 contracts traded today. About 59% of those were calls. At number 3, NVIDIA, courtesy of Mr. Pelosi, who used his insider trading skills and bought call options on NVIDIA, were all following the Pelosi ETF, of course. And therefore, NVIDIA came out at number 3 with around 800,000 contracts traded today. About 67% of those were calls. Can we have a politician with pair still intact who is going to veto or vote down the so-called CHIPS Act, which is a theft of taxpayer money worth $52 billion. Now, Intel made record profits last year. They can build their own factories. If they need the money, we can lend them the money. But this is a gift, charge-free. Who knows who's getting a cut out of this? The big guy, the little guy, who knows? What kind of money laundering schemes go with that? Which consulting firm connected to politicians getting a cut out of that? Which Cayman accounts getting a cut out of that? Do we have any politician with a pair intact who's going to vote down the CHIP Act? If we get that, Mr. Pelosi will get a pie in the face. In all likelihood, though, the CHIP Act will pass because they're going to use the national security excuse to give Intel a $52 billion worth of handout. But now that the news is priced in, will the passing of the CHIP Act produce a pop in these names or not? That remains to be seen. And therefore, I'm out of this. I'm not betting either way because the options premiums are sky high for AMD, NVIDIA, Texas, Intel. It's insane. If anything, you might want to use this opportunity of riding credit spreads to capture some premium. But anyhow, let's move on to cover the unusual activities that took place in the options market today. We start with the ticker NCR for, you guessed it, NCR. They're buying calls this time around. The stock is beaten and bruised year to date, but somebody's bidding for a rebound here, buying the 31 calls for the expiration date, August 19th, with expectations that the name could rebound higher and gain more than 6.5% by then. They paid around $2.75 a piece to enter this trade, all in all spending around $6.7 million. What about the ticker INTC? Speaking of the CHIP Act, they're buying calls. They bought the 42 calls for the expiration date, August 26th, with expectations that Intel will move higher and gain more than 8.5% by then. They paid around 75 cents a piece to enter this trade, all in all spending around $1.8 million. What about the ticker UAL for United Airlines? The name will report earnings this week, and somebody's betting for a pleasant surprise, and therefore they bought the 42.5 calls for the expiration date, August 19th, with expectations that UAL could move higher and gain more than 8% by then. They paid around $1.75 a piece to enter this trade, all in all spending around $4 million. And here it is. Speaking of the CHIP Act, the SMH, the CHIP ETF, somebody's buying big-time calls. They bought the 240 calls for the expiration date, September 16th, with expectations that the SMH will gain more than 12.5% by then. They paid around $3.70 a piece to enter this trade, all in all spending around $8 million. What about the ticker FCX for Freeport-McMoRan? Copper prices are rebounding higher, and therefore somebody's betting for more gains for FCX. It was up big today, but down big from the top. In any case, they bought the 29 calls for the expiration date, July 22nd, with expectations that FCX could gain more than 6% by then. They paid around 45 cents a piece to enter this trade, all in all spending around $750,000. And lastly, at the bottom of the table, what about the ticker TTWO? This is for Take-Two Entertainment. Somebody's betting for a massive gain to come here. The name is reporting earnings, and somebody bought the 130 calls for the expiration date, September 16th, with expectations that the name could move higher and gain more than 5% by then. They paid around $6 a piece to enter this trade, all in all spending around $8 million. Moving on to the heat map analysis, what's going on here? Mixed picture across the board, but the weakness is evident. It is evident in the recent winners. Healthcare down big. The pharmaceuticals down big. AbbVie, Eli Lilly, Merck. What does that mean? They're taking gains. They're taking profits off the table. They're also taking profits from the consumer defensives, the staples, PepsiCo, Coca-Cola, all down. Likewise, the ultra defensives in REITs and utilities were also down, taking profits from those two. They also took profits from the year-to-date winners in the defense contractors, Lockheed, Northrop. But are they rotating those gains someplace else? Are they buying the dip in the inflationary trade once again in energy and materials, steel, copper, fertilizers? Because those sectors were up. I doubt that this is the case. I don't have evidence supporting that that is the case. For all we know right now, the pop in energy and materials was based on the drop in the US dollar. Number one. Number two, short covering based on the action in the commodities market and the disappointment from the Biden Saudi visit. Are we seeing a rotation to chips, for example? NVIDIA was higher, but my hunch is that was based on the Pelosi trade. Are they rotating to the reopening names? The casinos, the hotels, the airlines? I'm not seeing solid evidence that that is the case. Are they rotating to the big caps? Apparently not. Apple was down more than 2% today. Microsoft down again. The big Goog is down over 2.5%. Meta is trading higher. Netflix was slightly higher. But there is no evidence that they're taking profits from the year-to-date winners in healthcare, the ultra-defensives, consumer staples, defense contractors, and they're rotating anywhere, maybe raising cash, but that's about it. Because even financials, yes, they're popping based on earnings, but we know there is a recession. You're not going to buy financials ahead of a recession. What does that mean? It means that all of that cash that got out of the market today still on the sidelines and can be applied in buying the dip. What does that mean? Earnings season will determine whether that cash will go into, let's say, buying the dip in the big cap technology stocks, maybe software, maybe chips, or the cyclicals, or if these earnings come out disappointing, then the cash will go back right in the defensives, the big pharma, utilities, REITs, consumer staples, defense contractors. So watch out how they're going to behave in the next few days as we get the slew of earnings. With that being said, here's some corporate news for you. Bad news for the big Goog, Alphabet, which we love and adore, of course, since I work for them. But here it is. Russia fines Google $364 million for hosting anti-Russian videos. And rumor has it Google will pay the fine using rubles. But it's not Russia who's cracking the whip on Google. It's also Denmark. Denmark banning Chromebooks and Google Workspace in schools over data transfer risk. And then we have Tesla, the souffle. More bad news. The regulators all of a sudden cracking the whip against Elon and Tesla. And the latest cracking is the regulators are opening an investigation from 2021 where a Tesla Model Y crashed and killed a motorcyclist in California. What about Boeing, aka the flying coffin? We're getting more good news from Boeing. We're seeing a short squeeze for now. How long will it last? That depends, but here is more good news for the flying coffin. Qatar Airways is now considering another order of Boeing's 777X jetliners, a potential boost for the hulking airplane that is running years behind schedule and struggling to gain sales. So good news for the flying coffin. We also have good news for Lockheed Martin. Even though the stock is down in anticipation of earnings, it will be a critical day for Lockheed. Most importantly, the outlook. That's what's really important. But here it is. We have exclusive from Reuters. The headline reads, the Pentagon nears F-35 jet deal worth about $30 billion. This is, of course, coming from Lockheed Martin. The most important thing for a shareholder, I'm a shareholder of Lockheed, what I'm looking for is the outlook. Will the CEO, the CFO talk about the increased defense budgets in Europe and Germany and many other countries? Are they going to talk about the insane defense spending that we're about to see in this country, not only to replenish all of the equipment that we sent to Ukraine, but now that we have geopolitical tensions across the globe, that merits more and more defense spending. On top of that, who's leading the hypersonic technology in the United States? The answer is Lockheed. Are they going to talk about all of that? And if they do, the stock will go higher. But if they talk instead about the supply chain issues, the shortages in chips, and otherwise, then the stock might go down. It could take the entire defense sector down with it. What about the heat map for the ETFs? What's going on here? We talked about the head fake in the XBI, the biotech ETF, as an indicator for growth. There was the divergence. Why is the XBI up while growth is down? Now we know it was a head fake. XBI is down along with growth. Growth underperformed value today, be it both of them in the downside. When we talk about technology ETFs, they were down, utilities down, consumer staples down, REITs down. So where did the money go? Looking at this heat map alone, the money went in buying the dip in the XOP, XLE energy ETFs. It went into buying the dip in the XME, which is the materials ETF. Also the XRT, surprisingly, this is one thing you don't see in the stock market heat map, but here it is. This is why we look at the ETF heat map. The XRT caught a bid, buying retail. We're also seeing buying the dip in commodities ETFs, specifically natural gas, the USO, UNG, BOIL, all moving higher. But even TAN for solar rebounded higher. It went down on Friday based on the bad news from Senator Manchin. Now we're getting a rebound, buying the dip once again. When we talk about international markets, they all performed a lot better than U.S. equities across the board, but led by China, the FXI, the MCHI, leading the gains in internationals. Any conclusions from the action that we got today? Can we make any assumptions that you go all in now, buying the dip in the KRE or in the XRT or in energy? Not really. For now, it's just a 1 day worth of activities, and it was a confusing day because of the conflicting news that we got. Apple, earnings, all of that will be sorted out by the end of the week. Meanwhile, let's move on in charts, and we start with the SPY, the S&P 500 30 minutes chart. What's going on here? Yesterday, we talked about my anticipation of a move higher in the SPY. And if that happens, we talked about 388.71 as the target. This is exactly what happened. We got a gap higher, stopped exactly at around 388.71, couldn't find the energy to build up on the gains, and then came the bad news from Apple, and we got the flush down. We didn't only lose 385 as support in the SPY, we closed at the lows of the day. This is a bad sign, not a good sign. If the SPY goes down further, we have the gap support at around 378.87, but watch where the RSI is trading right now. The RSI is becoming oversold, indicating that if we have any good news tomorrow, we should see a rebound higher. If that happens, the key question becomes, can the SPY close the day above 385? That would be a win for the bulls. Otherwise, the bears will take charge. But we're all waiting for the earnings from Netflix. That will set the tone. Unfortunately, that will happen after the bell. And for now, my hunch is, yes, we got a piece of bad news from Apple. They're freezing hiring, but watch how fast they're going to shake it off, like Taylor Swift, like nothing happened. So the main event really for tomorrow's activities is earnings from Netflix. The bad tone that we got from Apple, that could be washed out immediately by the opening tomorrow. We could see a move higher. And that's that. The question becomes, can we close above 385? What happened after Netflix reports earnings? What about the daily chart for the continuous contract, the SPY? The good news is we're not making any lower lows. Yes, the chart lost the most important support of 3,855, but it is still above the critical support from which we get a shorting signal, which is 3,720.5. Now, if the chart violates that support, we got a shorting signal. Meanwhile, we don't have anything at all, so very little damage happened for the bulls today. The volume remains muted, at least below average. The momentum indicators remain positive. So for all you know, if we have a shake it off moment, we could see the SPY futures easily trading above 3,855 by the morning. What about the Qs, the Nasdaq 30 minutes chart? What's going on here? We got the gap higher, just like we got with SPY. It did not get us all the way to my conservative resistance at around 297.5. I knew that was a little too high. The resistance right now that we have is closer to 296, but I like to be a little more conservative. The problem with the flush down that we got today, it is aggressive. The chart did not even bother catching support at the gap, and it went all the way down, closing at the lows of the day. If we go down further, the next support would be at around 285. Now, I doubt that will happen right off the gate in the morning tomorrow. It could happen after Netflix reports earnings. If those come out disappointing, that could happen. But for now, my hunch is we're going to have a shake it off moment in the morning. We see equities trading green to neutral. And then the moment of truth comes out after the bell. What about the daily chart for the continuous contract for the Nasdaq? Any damage here at all? Not really. The chart, in an attempt, made it all the way to the resistance at around 12,207. Did not make it, but it's not a rejection candle. It is not a reversal candle. The support of 11,689 is still intact. No damage done. The volume remains below average. The momentum indicators remain positive. The bulls are still in charge. What about the IWM, the Russell 2000 30 minutes chart? What's going on here? We got the gap higher, just like we got with SPY and the Qs. It got us all the way to the resistance zone from which the chart got rejected before, which is around 175, 176, and the chart pulled down. The selling was so intense, the chart did not even bother catching support from 174.22, and it went all the way down to catch support from 172.25, which is our soft support target. We have the hard support at 168.90. If we have more pain in the IWM right off the gate tomorrow, watch out for 168.90. I doubt that will happen. My hunch is we will get a rebound in the morning all the way to 174.22, maybe closer to that. And then here it is again. The moment of truth comes after the bell. The Dixie, the most important chart to watch, by the way. Yes, it was a down day, but is it a top? Do we have a confirmation that this is over? The answer is not really. The confirmation will happen once we have a crossing in the MACD indicator producing red impressions in the histogram. But we could have a fake reading just like we got before. So we need to see decisive, big, beautiful red columns on the histogram. You can wait for that, or you can read the tea leaves. You can look at the RSI, you can look at the MACD, you can look at the candlestick pattern. You could say, okay, let's say if the dollar rebounds higher and it goes all the way back to the highs, it will face resistance once again. This is a historic resistance. We might get the confirmation of the pullback after that. By reading the tea leaves, the risk versus reward says the dollar will go down. We don't know when. Is it going to happen tomorrow? Is it going to happen by the end of the week? Is it going to happen next week? But it's going to happen soon. When it happens, whatever catalyst will lead to that, you will see commodities catching a bid once again, and you will see equities also catching a bid in empathy. But if commodities rally too hard, that would be bad for the equities market because interest rate hike expectations will move higher again, and we will see the 10-year moving higher. We'll take it one step at a time, but for now, what about gold? Here's a daily chart. It is waiting and seeing what will happen to the chart of the dollar. Remember, gold is the mature guy in the room. He doesn't like to rally without having a confirmation that the rally in the dollar is over. For now, we don't have the confirmation, and hence, gold is waiting and waiting for that confirmation. The risk versus reward says, sooner or later, the dollar will find the top, if it hasn't already, and gold will catch a bid and rebound higher. What about UK oil, Brent? 4 hours chart, what's going on here? We're getting the rebound from the double bottom at around 99, and it got us all the way to the next resistance at around 105.84. Is it getting a little overextended? The answer is perhaps, but it can build up on the gains and shoot up higher. If it does, the next resistance will be 114. My hunch, though, is we will see a pullback. That will be a test. If the dip buyers show up again, then the chart of oil, no pun intended, has the energy to move higher all the way to the next resistance at around 114. What about the daily chart for the 10-year yield? What's going on here? It is facing a hard time passing above 3% as resistance, at least for now. We will look at the momentum indicators, the RSI, the MACD, they're firming up, indicating that we could see a pop higher. The problem is, though, we got pretty much every single catalyst available for now that merits a pop higher in the 10-year yield. It didn't happen. And the consensus for now is the Fed will not do the 100 basis points hike. They will stick to the 75, which means the fundamentals say the chart should pull down all the way to 2.75, 2.72, and try to find some support around there. Now, market bulls don't want to see a crash in the 10-year yield, because a crash in the 10-year yield means a recession. They also don't want to see a massive pop. And hence, if the 10-year yield stick where it is right now, trading sideways, that would be good news for the bulls. But would it be good news for the TLT bugs? Not really. But for now, looking at the weekly chart, we have a confirmation that the worst is behind us. And that supports the fact that perhaps the 10-year yield would not pop higher aggressively, at least not anytime soon, looking at the technicals from the TLT. The technicals say, yes, we have a down day, at least for today, for the TLT, but the suggestion here is the chart got severely oversold, and we should see a short covering rally. We should see catching a bid, buying the dip, and that could happen as market participants start to digest the fact that the Fed will not do 100 basis points or more in the upcoming meeting. They will stick to 75. Maybe the guideline will be lower than that in September, 50 basis points or 25. That would be good news for the TLT. We will see the pop higher, the short covering rally that the bond bugs have been waiting for since how about forever. What about the VIX 4 hours chart? What's going on here? The support of 24.29 is producing a double bottom pattern, at least for now. And the VIX is moving higher. If it continues to do so, and when we look at the MACD indicator, for example, from a 4 hours chart, reading the tea leaves, it looks like the MACD is firming up again. If it does, that means the VIX will move higher based on the double bottom, and the SPY will go down. Now, we talked about the support for the SPY. Will it go all the way down there? Because the VIX has resistance at around 27. How good would that hold? This is what I will be watching in real time in tomorrow's session. But again, the moment of truth will be after the bell when Netflix reports. What about the VXN? What's going on here? 4 hours chart for the VIX of the NASDAQ. The support of 32.72 is broken for now. That is a good sign for NASDAQ bulls. But we can play this game that the consolidation pattern was not actually broken. If we move down the support all the way to, let's say, at around 30, the VXN is still rebounding from support. The pattern has yet to be broken. You can play that game all you want, but for now, the apparent theme is we have weakness in the VXN, and despite the negative action that we got today in the Qs, the chart for the VXN, at least for now, suggests that the NASDAQ bulls still have the advantage. But here's the problem for the NASDAQ bulls. The king of the NASDAQ, the big kahuna, Apple, a daily chart, we have what it appears to be a reversal candle. Right at around 150, the resistance. The volume went higher on a down day, yet the momentum indicators remain positive, at least for now, and hence the risk of the shake it off moment. You know that right away if Apple recaptures 150 as support, let's say by tomorrow, and therefore I'm hesitant to buy put options based on the action that we got today. What about Tesla, the souffle? What's going on here? 30 minutes chart, we got the gap up, just like we got with the rest of them in the Qs and the SPY, but the chart flushed down after the bad news from Apple, closing the gap around 720.11 at the lows of the day, and we have yet to see the resolution from all of this. Are we going to have a rebound after closing the gap? That would be good news for the bulls. However, if the chart opens down in the morning, violating the support of the gap of 720.11, that means no rebound, and that leaves the next stop at 700 for support. If that's broken, that will initiate a short trade once again. For now, the bulls have the advantage, but the action that we got today suggests some weakness ahead. And lastly, what about Bitcoin? What's going on here? An hourly chart. So far, so good. Yesterday, we talked about the pattern of higher lows. Whether that's going to be intact or not, now we have the answer. The pattern remains intact. We have another higher low, and now the chart is battling the resistance at around 22,490. Now, here's what I want you to do. Forget about the action that we got in the NASDAQ and the equities market today. Your indicator is Bitcoin. If Bitcoin continues to gain ground and move higher along with the rest of cryptos, massive gains in Ethereum, for example, today, if that continues, then we have a risk-on moment. We have yet another indicator that the dollar will go down. And hence, despite the negative action that we got in equities today, the action in Bitcoin suggests that we will see a rebound tomorrow in the NASDAQ, a shake it off moment. But don't bet on that because it all depends on Netflix. Netflix will set the tone, and after that, we're going to have more clarity whether we will see the grand short squeeze, the short covering rally that we talked about in the beginning of the video or not. In the meantime, I'm moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have building permits and housing starts, important data for the housing market, but most importantly, what do we have in the earnings calendar? We have Johnson & Johnson, Lockheed Martin, and Netflix after the bell. Johnson & Johnson, Lockheed will be before the bell, Netflix after the bell. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.